First, just a quick disclaimer.
No sound, Mark.
Hold on one second. Okay. Our right line trading takes no responsibility for participation by visitors or subscribers for any profits or loss. We are not registered money market managers or are certified trade counselors, so, our commodity trading advisors. So just please discuss that with a registered financial advisor before making any investments. So with that said, what I wanted to, let's move forward. What I'm going to show you today is how to trade with advanced volume metrics. And it's really important when you day trade or swing trade to find low risk, high reward trading entries on the futures, forex, and stock markets. And one of the keys to that is trading with volume. Now, respecting volume profile generated areas of support and resistance is a critical and fundamental component to successful trading. Support and resistance volume zones will make 75% or more of your trade entries winners. Now, a lot of day traders and swing traders base their trading methodology on untested indicator analysis, untested trading methodology, and untested technical analysis. What we've done with this is we've done 2 years of market replay data and analyzed this very, very carefully to show that this clearly increases the precision of your trading entries. Now, there are 3 core trading principles that I want to start with. And the first is that support and resistance volume zones are dynamic, and they must undergo constant adjustment, and they have to recalculate intra-candle. And there's no formal zone of support or resistance. When resistance breaks, it becomes support. And when support breaks, it becomes resistance. And you can use a volume zone to show you exactly where to pull the trigger on a trade and really how to start making money consistently. Now, what I wanted to show you here was this is volume profile. And I'm sure a lot of the traders in the room are very, very familiar with this. And there may be some that aren't, but it's a very, very important volume metric to be very, very cognizant of. And what this is doing is showing you all the volume that's crossed and any individual price on any financial instrument. There are different ways of creating volume profile. We're going to show you some of them. And we're going to show you via the use of optimization techniques what the best way is to leverage this. Now, here's another example of volume profile. And all it is an auction style analysis. And every financial market is simply a bid ask where traders exchange a buy and sell contract or stock or share or lot. And what they do is they create a certain amount of volume at any given price. And the volume is represented in this histogram. Now I wanted to show you our the histogram that's created by our indicator. You can see it right here on the right side. It's these green histogram bars. Now, like I said, every indicator that you use, all your trading methodologies have to be grounded in good solid math. You can't take a priori that anything that you use to trade, any trading methodology whatsoever, is true just because you've been told it's true. What someone has to do is show you the clear-cut and fundamental math that it's based on to prove to you that it works. And volume profile analysis is really based on really clear-cut and sound math. Now, if you look at this bell-shaped curve, this is a normalized distribution of any type of data. Now, this could be the distribution of volume and price, as it might be on any given financial market, or the distribution of any type of data in any closed system. Now, in a perfect world, this type of data develops this bell-shaped curve, and this bell-shaped curve is the normal distribution of this data. And here, you can see it's at price. The mean price is this black line going through the middle, and that's the average price. And the average price is the one that accumulates the most volume. Now, in a normally distributed volume curve, the mean, the median, and the mode are all the same. And what happens is that one standard deviation's worth of volume is distributed symmetrically around this mean price. And this creates what's known as a value area. And this is a very strong and fundamental force that operates in every single financial market. And it must be respected if you're going to trade profitably. If you don't respect it, you're going to wind up with lots and lots of trading problems. And I'm going to show you that. I'm going to go into more detail about that. Now, here's just another graphical or pictorial representation of normally distributed data. The most common price with the most volume is the mean price, which has been named the point of control. The value area high and the value area low encompass one standard deviation's worth of volume, and that area is known as the fair market value area. Now, we're going to look at our volume profile or market profile. You can see our histogram in this JPEG is small. But what I wanted to demonstrate was this magenta line is our value area high. This magenta line is our value area low. And this black line is our point of control. So between, actually, I'm going to go to the next slide. So between the value area high and the value area low, 66 2/3% of all volume at price crosses. And this is fair market value for this financial instrument. And that's been determined by traders. And what traders want to do is they want to keep price within that fair market area. The point of control is the largest histogram bar, and it is the price. In this case, it's crude oil, but it could be any financial instrument. It could be bonds, it could be notes, it could be Google, it could be Twitter, it could be the euro pound, the euro dollar. It does not make any difference what financial instrument you're looking at. The math here and the value of volume profile is operational across any given financial instrument. So in this particular case, the price that traders want crude to trade at most commonly is $53.49. Now, this brings certain forces to bear on any financial instrument that you're trading. And here's what happens. Because price wants to stay within this fair market value zone, when price moves up to the value area high, it's repelled to the downside. When price moves down to the value area low, it's repelled to the upside. And because the point of control is the price that traders most often want to trade this financial instrument, it attracts price. So this creates very strong areas of support and resistance, which must be respected, because this is what traders are telling you is going to likely happen when price approaches these different areas. Price is going to bounce off the value area low to the upside. It's going to bounce off the value area high to the downside. And it's going to be attracted to the point of control. So the point of control is going to act as also as an area of support or resistance, depending upon the position of price. So now volume profile is dynamic. That's this series of histograms. Because volume profile, which market profile generates, is constantly changing. Now there are two things that must happen for this indicator, and it's really a trading system, to work optimally. The first is that the value area high, value area low, point of control, and two additional areas I'm going to discuss in a minute, have to calculate intra-candle. They cannot calculate a candle close. If you're trading a 3-minute or a 9-minute, or you're trading a 4-hour candle, or you're trading a very large range bar, you cannot wait for the candle close to recalculate these areas. They must constantly be up to date, and that must be constantly telling you in an accurate fashion exactly where these zones are located. Secondly, when you open up your chart every morning, you're going to get a volume profile. But remember that very little volume is crossed. Let's say, before a market opens, before the New York Stock Exchange opens, there's very little volume crossed on say, the E-mini S&P 500. Before the European session opens on the Forex, very little volume is crossed on any of the Forex pairs. So if this volume profile does not do a look back and accumulate data from a proprietary number of days, it's not going to have much weight when it opens in the morning. And the VAH, VAL, and POC are to get pushed around by any small gust of volume. So these areas are going to have very, very little relevancy. Now, if it accumulates too much data, then these areas are going to become too difficult to move. What we did was we optimized the number of days this looks back by looking at 2 years of market replay data to optimize the look back period. So it accumulates data, accumulates volume on a look back period, but not too much as to create areas that won't move, and not too little to create areas that just simply get pushed around by small gusts of volume. Now, in addition to the VAH, VAL, and POC, there are two other critical areas that must be operational to really optimize your ability to trade. Now, there are multiple low volume nodes on a volume profile, but there are only two critical low volume nodes. The low volume nodes are just the opposite of the point of control. The point of control is where most volume crosses at price. And low volume nodes are which very little volume has crossed at price. So for different reasons, these low volume nodes also act as strong areas of support and resistance. These are prices that traders have rejected, and they simply don't want your financial instrument to trade into that price. They don't want any volume to cross here. So you have to be very careful when trading into a low volume node. So what you do is you have these type of forces operational on a financial instrument while you're trading it. The VAH, the value area high, and the value area low are pushing price towards the point of control because traders do not want this market to trade outside of fair market value. That's one force. The other force is price is being pushed down by the low volume node here and up by the low volume node here for a different reason. And that reason is this is simply a price that's been rejected by traders. They don't want any volume to cross here. So when price approaches, there's a high likelihood that it's going to get rejected and attracted back to the point of control. So what we've done is we created what we call zones of rejection. When this low volume node is close to the value area high, and this low volume node is close to the value area low, you get a zone here that price simply does not want to move through. And when price approaches it from the upside, you get a zone of resistance that's extremely strong. And when price approaches here to the downside, you get a zone of support that's also extremely strong. You don't want to trade into these zones, or you're going to wind up with a loser. Now, the value of software is to define risk. You want to be able to take a look at your software and determine when you take a trading entry how much risk you're assuming on any given trade. If you are unaware of these zones, you're going to accumulate a significant amount of risk that you just can't know. And these zones of rejection are very powerful, and they're operational on every financial instrument. Now, the amazing thing about these are we all know, but let's say that you trade a 50-period moving average. That 50-period moving average on your chart, let's say you're trading a 3-minute chart, looks one way. On a trader who's trading a 6-minute chart, that 50-period moving average looks different. If someone is trading an 8 range, that 50-period moving average looks different again. So everyone's trading a 50-period moving average that has mathematical relevance, but is different on everybody's trading chart. But everybody who's trading the E-mini, irrelevant of the speed of the chart, 3-minute, 8-minute, 9-minute, 4-hour, 3 range, 5 range, has the same volume profile. And the value area high, value area low, point of control, and low volume nodes are the same on every single trader's chart, irregardless of the speed of the chart they are trading. This cross-sectionally is identical on every single trader's chart trading that financial market. And that gives it really amazing power. And you'll notice that if you put up the E-mini in this particular case on a 5 range, an 8 range, a 4-hour, an 8-hour, these zones of rejection and point of control, value area high and value area low, are all going to be the same because the volume profile is also going to be the same. Now, this is what I see on many other different types of charts. They create stable, fixed areas of support and resistance. And these areas are not stable, and they're not fixed support and resistance zones. It all depends upon where price is. This area is going to act as resistance until price breaks it. And then once it breaks it and retests it back to the upside, it acts as support. This is going to act as resistance until price breaks it and then comes back up. And then it becomes an area of support. Now, what we also look at is the volume ladder. And the volume ladder is a very, very misunderstood indicator. Lots of traders don't understand what it's telling you. Now, inside each candle, you're going to see a buy-sell imbalance, if there is one. Now, in this particular tick of this particular candle, this could also be a cent if it was a stock, or it could be a pip if it was on the Forex. There's a marked overabundance of buyers sitting on the bid-ask side of the trader. And that's printed if it's finalized when the candle closes. Here, there's also an overabundance of buyers sitting. Now, a lot of traders call these hidden buyers, but they're not really hidden. If you have a volume ladder, you can see where they are. Now, they have some predictive power when you're approaching an area of support or resistance, but the most important way to leverage volume ladder in your trading is this way. They do not guarantee that you're going to get a continuation of this candle. But what they will do is act as areas of support when price turns back around and heads to the downside. Because this hidden area, which is not hidden anymore, but this predominance of buyers sitting at this price level in this candle may stop price as it comes back around. Now, this overabundance of buyers are here, and you can either choose to ignore them and not use this metric in your trading methodology, but you do so really at increasing the risk of your trading entry. And what you want to do is make sure that you're able to see all the independent variables that come to bear on any given trade you take in order to make an accurate assessment of risk. You know that if you're going to take a short trade into this area, that you have a mild area of support that you have to break through. And this may have a bearing on whether or not you take this trade. That's how you leverage volume ladder. And it's an important component of trading with volume. Now, this is the way that a lot of different indicators project this data. And you can see it's very, very difficult to look at. There's a lot of numbers here that are just irrelevant. And when you get a lot of irrelevant numbers that really don't enter into your trading decisions to take a trade or step aside on a trade, it just creates confusion. So what we've done is we've simplified it. And this is the way our indicator looks. Very simple. We've eliminated all those numbers in each of those different tick values in this particular case, and just show you the buy-sell imbalance on any given trade intra-tick. A very clean chart. Now, there's a lot more information that volume can give you. Now, at the close of every candle, you can see up here there's a 0. I didn't shoot this JPEG when there was any numbers up here, but this is the market delta. And this tells you whether there's an overabundance of buyers or overabundance of sellers located in this entire candle. The number's positive, there's an overabundance of buyers. If the number is negative, there's an overabundance of sellers sitting on the bid-ask side of the dome. Now, on your trading chart, right, what's up here, you can see these numbers. That's the delta. 1812, 2985, 222, 1237. There's the candle delta. And you can see that in an up candle, you sometimes get a negative delta. And in a down candle, you sometimes get a positive delta. So it's very difficult to use a single delta in a single candle to make any trading decision. In fact, it's very difficult to use the delta on your trading chart to make any decision at all. So what we've done is we've taken these numbers off the 2 higher time frames than your trading chart. And the indicator determines that automatically. If you're trading a 3-minute, it looks at the 9-minute and the 27-minute. If you're trading a 3 range, it looks at the 5 range and the 8 range. If you're trading a 377 tick, it takes the 2 higher fib numbers. It looks at the 610 tick and the 987 tick, I believe. It automatically understands what your 2 higher time frames are simply from the speed of your trading chart. And what we do is we take the moving average of the delta of the 2 higher time frames and we create an order flow direction. Now, the order flow line down here gives us really important information. When the line is red, it tells you that the market delta moving average on your 2 higher time frames is moving down, showing a strong overabundance of sellers on the bid-ask side, pushing price to the downside. When the color is orange, just your longest term time frame is to the downside, but that longest term time frame rules. So it sets a direction for you to trade. When it's green, the market delta moving average of your 2 higher time frames is showing buying pressure. When it's blue, it's just your longest term time frame with an overabundance of buyers or buying pressure. So it sets a direction to the upside. Now, the important thing to note on this particular slide is that that this line is red, not because price is falling. Price is falling because this line is red. This line is not created by any data from your trading chart. It's created from the data coming in from the 2 higher time frames. This line, this price is going up, and it's not creating this green and blue line. This green and blue line is telling you that there's buying pressure here on your 2 higher time frames, and price is almost always going to rise. Now, here are the kind of trades you can take. Here's your zone of resistance and zone of support. You always want to trade in the direction of order flow, which tells you whether you have buying pressure or whether you have selling pressure. Now, I've highlighted this for a couple of reasons. You have price coming down to support, and you see that you have multi-time frame buying pressure. You take the trade off support to the upside, comes back to support, take the trade to the upside, comes back to support, take the trade to the upside. That's a 31 tick trade. This is all off of the direction of multi-time frame order flow of your higher time frames. You want to take a counter trend trade, you have to wait until order flow reverses. And when it does, then you can take a great low risk trade to the downside in the direction of this huge selling pressure on both your higher time frames to come down to support to take it out at 33 ticks. Then you're going to wait for price to come back up and test what this used to be support, now it's resistance, and to head back down again in the direction of order flow. Another trade. Now this trade comes down to support, but order flow is still showing you excess selling pressure. So when you trade with specificity, and it's all about the math, you cannot take this long trade. When you're on the right edge of the chart and you can't see what's going to happen, and you see that the indicator is telling you that there's still selling pressure going on in the market on the higher term time frames, you're going to have to let this trade step. You're going to have to step aside on that trade. You can't take this counter trend trade because you have an overabundance of buyers. You can't take this counter trend trade. There's an overabundance of buyers. Then you wait for the market to shift. Now you take the break of the point of control, the retest to the point of control in an environment where there's a strong overabundance of sellers, and you go down for 61 ticks. Now these zones of support and resistance you're able to assess their strength by how confluent the low volume node is to the value area low. When it's wide, the zone is weaker. When they're confluent, the zone is tougher. So you can see that this is a fairly weak zone of support. So instead of taking the trade off at support, you can, via the evaluation of risk, make the assumption that this area of support is going to break and take the trade all the way down to 61. Another trade. And this is a break. This area, when price is sitting inside this zone, you don't touch it. You have to wait until there's a 2/3 candle break above the zone. This is based on Japanese candlestick dogma. This is the first candle to break the zone cleanly, and up you go for 27 ticks. Now you can take a trade here, but this is a riskier trade because you don't have a formal break of resistance, no formal break of the value area high on this particular entry. Here's another trade. I'll move through the value area low, or this particular zone of rejection. I'll pull back into resistance and a trade in the direction of order flow down for 18 ticks. Here's another trade. A break of resistance, it turns into support, come back to support, trade long in the direction of order flow for 2.5 points. Now, I don't want to make you think that every trade is a winner, but you're going to get over 80% of your trades, and 80% of your trades will be successful if you respect these areas and always trade in the direction of order flow. It's extremely important. Now, we wanted to make the indicator more powerful, and for this particular webinar only, we're going to add this component to the indicator as a special, because there are really two forces going on in the market. Besides order flow, there's also momentum. And what we use is modified or multi-time frame modified Heikin-Ashi momentum to turn that single order flow line into two lines. And this modified Heikin-Ashi momentum is doing the same thing that an order flow is doing. It is looking at the two higher time frames and assessing momentum on your two higher time frames. When these two different forces in the market align in the appropriate direction, the same direction, as you trade, the predictive power of a trading entry is enormously high. So when you're trading in the direction of order flow, multi-time frame assessment, and momentum, multi-time frame assessment, respecting these areas of support and resistance, you're going to very likely get a winning trade. Now, you can't take a long trade here, but this is exactly where you get these lines in sync. So you're looking for a long trade. You know the direction you want to trade. You have to just wait for an entry. As soon as you get the 2/3 candle break of this area of resistance, you're into the trade. Then depending upon your automatic trade management strategy, you're either into the first reversal candle, or you can take the trade all the way up to the top. Now, here's what happens when the higher line, momentum, and the lower line, order flow, don't correlate. This happens sometimes. The market breaks down into chop. And if you've ever wondered why the market moves in chop, this is one really good reason. There are different independent variables that come to bear on price, and they totally are independent of each other, and they both create forces on price. And sometimes they just don't align. So When there's an overabundance of sellers, but momentum is to the upside, you have to just step aside and not trade. When these come into alignment, and you don't know which way they're going to come into alignment, and maybe that momentum rolls to the downside and you're going to take a short trade. But when they do come into alignment, and they come into alignment right here, that's where the trend begins. And you get a movement above support, a retest of support, and a move to the upside in the direction of order flow and momentum, both created from your two higher time frames. No data is assessed from your trading chart. And that's what creates such tremendously powerful predictive value for these indicators. When you have indicators that assess data from your trading chart, from what we've seen here at Right Line Trading, and for all the mathematical analysis what we do, and my background is in mathematical modeling, the indicators have no future predictive value on price. They are not going to tell you the future movement of price if they're using data from your trading chart. They cannot look out into the future. They have to look at other markets, or they have to look at higher time frames. And here's another. This is a trade I took in our trading room. Short trade, a momentum and order flow to the downside. A long trade, momentum and order flow to the upside. And you can see the volume ladder present in each of these candles. Now, we also calculate a market delta moving average off your trading chart. The only indicator that we use that accumulates data off your trading chart. And that's simply these numbers, the delta of the candle, and we plot a moving average. And it does have predictive value. And you do want, if you trade in its direction, it does help you. But order flow is the key metric to use to take a trade. Here's another trade. And I could show you 100 of these trades. Right now, you're trading underneath resistance, but you know the direction you want to trade. You simply have to wait for the price for the price to break resistance. When it does, you're in, and it flies to the upside. Here's a counter trend. Now you have to assume that you're going to break the point of control. And you can make that assumption if order flow and momentum are both aligned in the appropriate direction together. And the trade just won't. It gets held up at the point of control, then breaks. Whoops. These are both trades I took in the live trading room. This one was 7 3/4 points. This one was 2 1/4 points. You can see how important it is to take those trades in the direction of multi-time frame momentum and the multi-time frame analysis of order flow. In addition, if you look at the market delta of our trading chart, it's rising throughout the entire trade. The overabundance of buyers, or the buying pressure on this financial instrument, was simply increasing throughout the entire time this move was going up. And it continued to rise even after we exited the trade and price became somewhat choppy, but it continued to go up. This is another trade I took in our live trading room. Break, retest, order flow and momentum. This is a separate line. Here's our market delta, which didn't have any data accumulated because I just opened the chart. It's up for 17 ticks. Here's one for 20 ticks. Trading in the direction of our chart market delta and our multi-time frame order flow and momentum. All green to the upside. Off support. That's the same one I just showed. Here's 24 ticks. Up. I kind of cut that off a little bit, but that's green. Now, I wanted to use this to highlight something. When these zones of support and resistance become confluent and they squeeze price like this is just when you sit on your hands. This is the time you decide you're not going to trade. You don't want to trade into upside resistance or trade into downside support. Remember when we had both order flow and momentum aligned, we waited for price to break resistance to the upside to trade or to break support to the downside to trade. So here is when, we talk about trading psychology. Here is when you can use that psychology and leverage it via the use of your indicator analysis. Your indicators are telling you that you're squeezed between support and resistance, and you're simply going to sit on your hands, irrespective of what your indicators tell you, until you break resistance or support. Then you're in the game again, looking for a trade in the direction of order flow and momentum. If you break support to the downside, you're going to look for a retest up and then down again. If you break resistance, that's support. If you break resistance to the upside, you're going to retest support and then for a move up. So we're looking at market profile, which is created by volume profile. We have a value area high, a value area low, a point of control. We have our low volume nodes creating our zones of rejection. And we have our delta moving average. Now we're going to have a delta moving average on our chart, and we're going to have our delta moving average on our two higher time frames that create our order flow indicator. Then we're going to have our intra-candle volume ladder, and then we're going to have our modified Heikin-Ashi momentum being assessed on our two higher time frames to help increase the predictive value of our trading entry and combining it with order flow. Now, this is the offer that we're going to make you on the webinar special, and this is for the first 5 orders only, including the indicator system and trading system. We're going to put you in the trading room and you're going to trade with me 3 mornings a week. Every morning, every day. The room opens at 9:15 Eastern Time, closes around 11:30 Eastern Time for 3 months. And I take very few losers and a lot of winners. And you're also going to see the value of your automated trade management strategy. And that is what happens to the trade after you get in. How do you optimize the amount of profit you get and how you minimize your losses? It's done with psychology, but it's also done with math. You want to create the best trade management strategy you can on every financial instrument. So once the trade ticks in, you just sit on your hands. You let that first target hit, you let your trailing stop kick in, and you try to get that trade all the way up to your third target and create the maximal profit you can. And we have a very unique exit strategy that gets you out of the trade with minimal amount of losses. You're also going to be given our 10 weekly educational training session. Now it's a 10-module series. We finished 4 of the 10 modules. You'll get those 4 modules on a link. There was supposed to be an hour session. They're averaging 1 hour and 45 minutes a session. And I am going to teach you how to become a professional, profitable day trader. At the end of the 10th session, which is probably going to be about 30 to 40 hours of time, you are going to know how to trade. And we're going to do that all for, hold on 1 second here. Let me just find that slide. Because that slide was not for all the add-ons. Let me just go back to that really quickly. That was just for the bear indicator by itself. Okay, hold on. For $9.79. Now, the first 5 packages, get all the additional add-ons. And the discount offer itself expires on June 18th. So we're going to put you in our trading room for 3 months. I am going to teach you how to trade. And we're at www.rightlinetrading.com or info@rightlinetrading.com. Here's our phone number, 855-765-6681. And here's the link. I think it's going to be placed in the room. I only have another minute or two, and I want to get to questions. I only have a couple of minutes, but I want to get to questions, and I'll leave that link up. But when you're finished with this 10-week series, and you're in the room for 3 months, I'm going to show you how to become a professional, profitable trader. And we make money in the trading room almost every single day. Now, hang on 1 second. Okay. Okay, these are all the questions that go way back. Hang on 1 second here. Hang on, let me just go all the way to the bottom here. Yellow means it's flat, Stephen, and it has no direction. You know, Aaron, I would be happy to show you Amazon. I just don't have the time. This trades great off of any trading instrument, and you can use it to trade off of any single stock. I have a dual data feed, both kinetic and CQG, that allows me to use this on stocks, and it really trades great. Yes, Gary, we do. Yeah, we're using value area low, high, because you have to accumulate some data from previous time frames, Stephen. It's a must. Listen, you can trade a 1-day time frame, but it doesn't have as much predictive power as one that goes back a proprietary number of set days. You weren't taught wrong. It's simply the discretion. It's simply what we believe provides you with optimal power. You can look at a 1-day, a 5-day, a 1 week, a 1 month. What we try to do is set a proprietary look-back volume period to provide the volume profile with optimal stability, but keep it nimble. So there really is no right or wrong. We just believe that the amount of volume that's accumulated in our look-back period provides it with the most predictive power in creating tougher areas of support and resistance.